Have you ever pondered the differences between operating and financial leases? These two types of leases, while similar in some respects, have distinct differences that can significantly impact a business's financial standing and operations. Picture two companies. Company A is a delivery service that leases a fleet of vans. This is an example of an operating lease. On the other hand, Company B, a manufacturing firm, leases heavy machinery, a case of a financial lease. Starting with ownership in an operating lease, the lessor retains the ownership of the asset, like the vans leased by Company A. This means the leasing company holds the title and can lease the vans to another business once Company A's lease term ends. In contrast, with a financial lease, the lessee, Company B in this case, assumes many of the risks and rewards of ownership. Although the leasing company technically owns the machinery, Company B acts as the owner and can even buy the asset at the end of the lease term for a nominal price. Next, let's delve into how these leases affect financial statements. An operating lease is an off-balance sheet item. The lease payments are treated as operating expenses, reducing Company A's net income. However, the vans do not appear as assets, and the lease does not contribute to the company's liabilities. On the other hand, a financial lease is a balance sheet item. Company B must record the machinery as an asset and the lease payments as a liability. While this increases the company's assets, it also increases its liabilities, which might not look great to investors or lenders. Moving on to tax implications with an operating lease. Company A can deduct the entire lease payment as a business expense. It's simple and straightforward. In the case of a financial lease, Company B can deduct both the depreciation of the machinery and the interest portion of the lease payment. This can provide a significant tax advantage, but requires careful calculation and record keeping. Finally, consider the lease term. Operating leases are typically short-term agreements, allowing Company A the flexibility to upgrade their fleet regularly. Financial leases, however, are generally long-term agreements. They tie Company B to the machinery for a significant period, which might be suitable if the machinery has a long, useful life and is crucial to the company's operations. In summary, operating and financial leases differ in terms of ownership, financial statement impact, tax implications, and lease term. An operating lease offers flexibility, simplicity, and fewer obligations. A financial lease, however, provides tax advantages, asset control, but with more responsibilities and longer commitments. Understanding these differences can help businesses make informed decisions about how they acquire and use assets. So, the next time you hear about operating and financial leases, remember, it's not just about renting an asset, it's about the strategic impact on a company's operations and financial health.